one of the most common questions I get is this market gonna hold? What if I told you that the S&P could still move 20% higher this year? It's possible, says wealth manager Doug Flynn. Doug is co-founder of Flynn Zito Capital Management. He joins us from his office in Garden City, New York. Doug, good to see you. You know, a lot of people use that adage, sell in May, go away, and the implication is that the market isn't going to do better than it does in May.
Yeah, that's a common thing that we hear, and actually what we did was we looked at the last 10 years to see if that actually held true, because it certainly feels like it might work, but it actually only worked in 3 of the last 10 years. So if you sold in May, 7 of the last 10 years, you actually would have been worse off than just hanging in, which I think is the lesson there.
Yeah, one of those years, by the way, was 2008 when you know, the bottom fell out of the market. The issue really is whether this market, generally speaking, forget adages, generally speaking, is overpriced. And I hear opinions across the board. If one looks at price to earnings, might be a little bit, but generally speaking, you know, do we look at time spent running up as a reason to sell stocks?
No, what you have to do is you have to take a look at corporate earnings. And with the market running up, so have corporate earnings. And that's really where you get that potential for probably another 15 or 20% with current corporate earnings before the market tends to get overvalued. So what has to happen there is companies have to continue to execute and continue to grow their earnings. If they don't, and the market keeps moving, that's where the earnings are stagnant, the prices have gone up too much, and that's where you get an overbought market or an expensive market. But what will happen is if the companies continue to grow and their earnings continue to move forward, then the market can support an even higher price and a higher overall level than it does today. So that's what you have to look at.
Okay, you're not giving us stock names, but you're giving us sort of categories that people should look at in terms of what to invest in right now. And obviously, value stocks. Value stocks define those types of stocks that seem undervalued or you know, have more potential value in them as opposed to momentum stocks or even growth stocks.
That's true, and you can actually get on the internet and look for large company value stocks versus large company growth. And a quick look at that, if you look at the market overall over the last 12 months, the S&P 500 is up about 16%. Value stocks are up only 13%, and growth stocks are up over 20%. That's the 12-month numbers. If you look year to date, value stocks are starting to outpace growth. And so what you tend to find is that when one outperforms the other, in this case growth has outperformed value, it tends to flip-flop, and therefore there's more opportunity in the one that is underperformed over the last 12 months. So that's where there's some opportunity. Plus those value stocks tend to pay a decent dividend, and a lot of people like the dividend. They can reinvest that or take it for income if they need that.
The residential real estate in this country is up about 12 or 13% over where it was a year ago, but most indices suggest some sort of slowing down in the arena. Why do you suggest people look at real estate?
Well, so we're talking about real estate stocks, right? That's an ETF or a stock fund that you can get into. And what I like there is of all the 11 sectors in the S&P 500, and there are 11 of them, real estate is actually the worst performing one over the last year. It's actually 0. So it's the worst performer. However, year to date, it's the best performer. And so what will happen is that momentum will tend to ride for a little while. The next best one is utility stocks. That has the second worst performing numbers over the last 12 months, but the second best performing numbers for the year to date. And so those are trends that you can play if you already have a diversified portfolio and you're looking to add certain sectors that might bring some additional value for some time.
I skipped a step, though. You're not telling people get out of the market because it's overpriced. You're telling people look at it. Look at your portfolio, analyze it, rebalance it, and you might want to sell some of the things that are winning, and these are areas that you might want to look at as having some potential growth.
Absolutely. We have 4 R's here, and we have review, reallocate, rebalance, and repeat. Those are the 4 R's for success. Timing the market, selling in May and going away doesn't work continuously. But what does work are those types of things, looking at it. And you know, if you look at the last 40 years in the market, the best performing mix of assets would have been 80% stocks and 20% bonds. And the reason is having a little bit of fixed income. Even if you're very aggressive, where you think I want to be 100% stocks, having a little bit of bonds allows you to rebalance into and out of the market. Think about it. If you're 100% stocks, what are you going to rebalance out of? You have nothing to rebalance out of. So in a year like 2007 or 2008, where you have those huge swings, that's where the value comes in, having a little bit on the side to rebalance within. And so that 80-20 mix over the last 40 years actually outperforms 100% stocks with a little bit less risk.
Is there anything, when you talk about risk, in terms of event risk that worries you right now in the world? You know, because we're endlessly talking about things that are going on. China's economy slowing down, Russia and Ukraine and China, things going on there. We were talking about Thailand just before I introduced you. Are there any events in the world that worry you in terms of investments?
There's always that worry. That's one of the things that you can't control, are the geopolitical things that you may wake up tomorrow and have something completely out of the ordinary. And that's why when you're talking about the stock market, you know, if you need your money in the next 2 or 3 years, you probably should be pulling some money off the table at the all-time highs. But if we're talking about money that you know you don't need for a decade or more, you have to look at it, but there's a little bit more room here. Now, that being said, there's also the fact that we haven't had a 10% or more correction in quite a while. But that's an opportunity. And so real quickly, if you look, let's say you did the sell in May and go away strategy starting in 2008. So you think, I'm a genius. I only lost 3% in 2008.
As opposed to 37%.
That's right. But if you then did that and repeated it every year for the next couple of years, you would have had a total return from 08 till now of 27%. And then that poor person who lost 37% that first year, but hung on till now, their total return would be up over 43%.
All right.
So even losing 37% in that first year
would have given you a better outcome.
Right, by hanging on. And so that's why we know that having a long-term time horizon for stocks, you might have some bumps even out the gate or with new money, but if your time horizon is right, it will work itself out over time. So you just have to watch the valuations and not just chase and throw money at the all-time highs willy-nilly. Look for these spots of value and be smart about it, and then rebalance and reallocate and do that. Either do it yourself or look to a professional who can help keep you honest on that and do it for you on a regular basis, because that's what wins.
Doug, always a pleasure to see you. Have yourself a remarkable Memorial Day weekend. We'll see you soon.
Thank you, Ali. You too.
Doug Flynn is the co-founder of Flynn Zito Capital Management. Coming up, spying at work with your every move under surveillance.